Yield, return on capital employed, return on investment, net position, all important metrics. But why is it the most important one of all, internal rate of return, is forgotten in property investment? First of all, what is IRR, the internal rate of return? Essentially, you can think of it as a predictive growth metric of what the asset, or in this terms, property, is going to bring back to you. And this shows an all-inclusive prediction of the rental returns and the capital growth all in one over a set time period. So for example, if you know there's going to be a 10-year time frame of keeping this property, it gives you the overall predicted return. This is really important for two reasons. Number one, it shows you a comparison metric against other investments, such as another property or a block of flats or a stocks or shares, so you can compare it against alternative investments. But what it also shows is what you can really pay investors and still make a return. And you'll kind of be shocked just how much you can pay somebody else and it still be worthwhile. Until now, I have thought to never mention it in terms of a buy-to-let portfolio because it is bloody complex. Let me show you the formula, and this is how you work out the internal rate of return on your property. So you have something called the net present value, which is adjusting for zero, and then you input this equation in your spreadsheets. It's just not going to happen. That is until today's video sponsor, Lendlord, which is a piece of software I've been using for a while now to estimate and evaluate my property deals, have incorporated it into their software. So pause the video right now if you don't have it. Click the link below to the Lendlord app, completely free. Fill it in and sign up because we're going to be using it in today's video. So hopefully you have downloaded Lendlord now. If you haven't, definitely get on it. Open it up on your laptop if you're watching this on your video. Fill in your details. This version's completely free. And, you know, I'll do some more videos on this so you can go back and watch the others prior to this, but it breaks down the deal analyzers and everything like that. So there's a lot to do with Lendlord that really breaks it down: profit and loss statement, transactions, tracking all of your tenants, building your portfolio in there. And I used this as a dummy account prior, so I'll just show you that quickly and what it looks like. So these are 10 of my properties that I've got, the property values, purchase prices, rental income, stuff like that. But it also links you up with a lot of lenders, so it's kind of like a Equifax or credit expert, if you like, for your property portfolio. I am obsessed with the deal analyzer, and what I love about it is it takes account of the short-term metrics and the long-term metrics. And a big mistake that a lot of people make investing in property is just looking at short-term metrics. Now, naturally, the smaller we are as buy-to-let landlords, if it's our first property, our fifth property, we're obviously going to be a lot less sophisticated compared to people that are buying their 100th property, or people that are in a situation where they're buying a huge block or a massive skyscraper and things like that. Now, what you'll notice as you're looking at more advanced property metrics is things like debt coverage ratios, which this covers here, 4.94. Things like internal rate of return, the IRR, equity multiples, and the GRM, and this is a number of years that's going to take to pay for itself. They're all really important comparison metrics when you're looking at a selection of investments. So all of the investment banks do this, all of the private equity firms do this, all the mezzanine finance does this, but we as individuals don't do it. And one of them is because, or one big reason of it is just ridiculous, how ridiculous the equations are, and understanding them. It's quite a lot. So if you look at the net present value, most people find that quite complex, because what you're doing is you're looking at the cash-free rate or the risk-free rate, and you're applying zero, which is, ignore what I've just said because it's quite advanced. But in general, the reason the internal rate of return is so important is it makes a prediction on the long-term return. on this, and this is dependent on the length of time. So I've put in some basic details here, but I really want to show you this. And as you can see, if we go back to the equation here, how complex and how ridiculous that is, and even putting that into a spreadsheet that you might use is quite complex. Whereas when you look in on here, it's automatically got it. So that equation is embedded in the background of Lendlord, and this is what makes it so powerful as a platform and why we use it so often analyzing our deals. So let's assume a random property. Let's say I don't know, £200,000 purchase price. Let's say the property is also worth 200,000. We're not getting a discount. Rental on that, let's say 1350. Just as an example, you've got your stamp duty already calculated, and you tick that box as an additional property. Remember, in the UK, you have additional, it counts as an additional property when you buy an investment. So you're going to do that, and let's assume there's no refurbish cost, and you've got closing costs, which is your solicitors, really 1,500. This is just as a generic example. So what most people look at are these left-hand metrics. First year return on investment, your cash on cash investments, which is return on capital employed, and your net yield, which is great. Some people look at cap rate, the capitalization rate, which is how, as a percentage, it will take to sell it. So if you've got a cap rate of 6.88%, that is as a percentage of the overall value. But really what I'm interested in is this long-term metric. And if you come over here onto your long-term assumptions, this is where it really makes difference. So remember, internal rate of return, it's not factual, it is not completely black and white, it is assuming certain things, okay? So for example, it is a guesstimation or prediction on the overall return, including capital growth, including reinvestment value, including cash flow. And if you want more videos on this advanced stuff, let me know in the comments and I'll do some more videos on it. But let's assume we're going to keep it the same. Let's assume this area, we get a 1,350. Okay, but we know this is a really solid area, and we're looking at 7% capital growth, and we're looking at a 10% rental. That's probably a bit too high. Let's say 7.5% rental appreciation. Let's keep annual inflation at 1. It's not, but it's really as a comparison metric. And we'll keep it at 5 years. Watch this percentage here. The IRR is 27.95%. That means that the predicted overall annual return over a 5-year basis is 27.95%. Number one, that's going to be used as a comparison metric when you look at a variety of properties. But also what we want to look at is when we are borrowing money, or somebody's lending us money and we're going to borrow it, what rate could we theoretically pay an investor to make this worthwhile? Now, most of us are not going to be paying 27%, but if you look at the likes of real estate billionaire Grant Cardone, and he's dishing out 16, 17%, it's just like, well, how is he dishing out that much money when the cash flow doesn't facilitate that? And it's because he understands the internal rate of return, or the overall value that the portfolios are bringing in. So when you're in that cash-rich position, what you can do is use other properties to pay investors until you get that increased value, refinance out, pay back the investors, and then you are left with this, in his case, 4.8, I believe, don't quote me on that, $1 billion worth of real estate that he's paying out investors and getting them out every single year, leaving him with a multi-billion-dollar portfolio, using debt and other people's equity. And this is why it's so powerful, because your net worth is your net worth, and how you utilize other people's money is what allows you to grow so quickly. So let's assume this, and then we compare it against another £200,000 property, but let's assume it gets $1,500 instead of the monthly rent. Well, initially you might go, that's great. If we look at that back figure, by the way, the 1,350 I said, 27.95%. So if we went to 1,500, but this was an area where we actually had only 5% chance of capital growth based on experience in the 5-10 years before, nothing else changes, you might think initially this is a better deal because it is based on the first year. But looking at the 5-year, what happens is if you look at the internal rate of return, it's actually lower. Not significantly, but it is actually worse overall. And bear in mind, that's quite a margin, £150 on a monthly basis. So whilst the cash flow of one is better than the other, because you take account of the capital growth, the internal rate of return shows a much more positive attribution to the other property that was getting a lower amount of rent, but a higher prediction of capital growth. And that's the other thing that I'd really point out here is 3 things. Number 1, rental appreciation impacts the IRR, internal rate of return, less than capital appreciation. So for example, if I add 2% here, it goes from 26.59 to 27.29. Whereas if I increase 2 here, it goes from 26.59 to 29.87. What this tells us is that capital growth is the strongest indicator for the strongest long-term returns on this. And this is why beginner property investors focus just on cash flow, which I get, get the money in the bank. But actually, the real investors out there, there's a reason they buy these massive properties in London that seem to cash flow next to nothing. It's because the internal rate of return is so much more significant at a capital growth strong location. Now obviously that's changed over the last couple of years because it's all over the UK, but in general, long term, London is going to be one of the safest bets for that, right? It's just the prices are not particularly attractive for a lot of people. The other thing to get is that internal rate of return will lower the longer the time frame, okay? So if we look at 5 years, we've got 29.87. And if we go to 10 years, it's 28.11. So it drops a little bit, and that's because of the lowered reinvestment rate. So hopefully that gives a very brief, basic understanding of internal rate of return. I've not deep dived into the equation to really break down all of these asset values. If you think it will really help me doing a bit of a geeky video, breaking it all down, the actual bits of what, so you can understand the equation more, put IRR in the comments below, and I'll spend some time really thinking of a way to explain it in the most basic terms that I can, and explain net present value and internal rate of return in more detail. But what you need to understand is it is an incredibly important metric, and until Landlord has come out and really made this available to us, it was a really complex equation. So make sure you're downloading Landlord. Again, they are today's video sponsor, so thank you so much for that. If you've ever watched any of my review videos, I will only give honest feedback, and whilst there's a lot to improve on this platform, and they are reinvesting significantly based on the feedback that you guys give as well, so let me know in the comments what you think. But they really are pushing forward, and for me, as an overall software, it is insanely valuable for what it does compared to anything else that I've seen in the market, and 99% of it is free as well. So there's no actual ongoing cost from this until you're ready to take advantage of some of the lending and bits like that, which is obviously helping you build out your portfolio. So let me know what you thought in the comments. If you want more information on internal rate of return and why it's so important, put IRR in the bottom in the comments, and if you got value from this video, make sure to hit the like, click the link in the description if you haven't downloaded this, fill in your details and watch this video again so it really sinks in for you. And if you're new to the channel and you want to find out more about property investment, hit the subscribe and the notification bell, and I'll see you in the next video.